Now, keep in mind that lighter than expected caused the market to kind of like rally a little bit, especially things like Bitcoin. And then coupled with a maybe more pro cryptocurrency administration, we've kind of seen that at least hold, although it's not like rocketing yet. But we need to keep in mind that that number, although it came in lower, was still over 3%. So when we look at what the Fed keeps telling us, they're telling us that they want inflation to be at 2% or less.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, our good friend Eddy Gifford is with us to go over last week's CPI numbers and how he sees them going ahead, as well as let's talk about the year ahead, because we are in January. Never forget the January effect. We had 220+% gains in the market back to back, something that hasn't happened in a long, long time. Eddy, it's great to have you back on, and Happy New Year. A little belated since we're almost done with January, but we haven't seen you in a bit. What of the CPI numbers?
Yeah, first of all, thank you for having me. And yeah, like we headed into last week wondering like what's going to go on with CPI, and fortunately it came in lighter than expected. Now keep in mind that lighter than expected caused the market to kind of like rally a little bit, especially things like Bitcoin. And then coupled with a maybe more pro cryptocurrency administration, we've kind of seen that at least hold, although it's not like rocketing yet. But we need to keep in mind that that number, although it came in lower, was still over 3%. So when we look at what the Fed keeps telling us, they're telling us that they want inflation to be at 2% or less. And it's funny because I was just talking to a friend yesterday and he's like, do you think it's going to come back down? I'm like, no. That's not the goal, right? Inflation doesn't come down. It slows down and it just continues to stack on top of each other. So we're still a full percentage point away from getting to the target. But even when the Fed gets to the target, that means things are still going to be 2% more expensive next year than they are this year. And that's based off their definition of CPI, which a lot of households would argue that what the numbers say, the big picture CPI numbers say compared to what they're actually experiencing at how each level are much different. So I think there's a lot of quiet optimism. It seems like there's a lot of catalysts for good change with the new administration. Of course, we need to keep in mind that all change usually causes pain before it causes gain, right? I mean, I can decide that I want to lose 20 pounds this year as an example, right? And I'll be healthier next year because of it. But it doesn't mean that the whole year is not going to have trials and tribulations and that there's not going to be like bad things that happen or that I'm not going to fall off course every once in a while. So I think we need to keep in mind that like this first year of the administration, although I think they're going to be pushing for a lot of positive change, it's kind of like that first month or two of a diet. It sucks. It comes with some pain. It comes with some adjustments. It comes with those types of things. So I think that we're in store for volatility. I think that CPI numbers seem to be working to our advantage, but inflation is running away in Japan right now, which the Bank of Japan is getting concerned. And the thought is they may raise interest rates this week. They're having their version of their Fed meeting this week. And the last time that we saw a rate hike from Japan, we saw a massive pullback in the stock market. This was last year in August. And so I don't know if there's going to be a catalyst there again. But I do think it bears like paying attention to, because you don't unwind 15 years of easy policy in 3 days. So we are in for an interesting year for sure.
So you think we'll have a pullback though? There's 11 months left. We'll definitely have at least a 10%, but 20% or more?
I don't know. I think something needs to break for that to happen. We already had one of the worst Decembers we've ever had. Yeah, I mean, Santa Claus did not decide to show up this year. The tail end of the solid cause rally. We had like the last 2 days of it were positive, but December in general was not good. So we kind of had like an election hangover in December. And, everyone, now that Trump is officially in, it seems like we're kind of like catching up to where we were. But there are, a number of things that could happen. We've been talking, Terry, you and I have been talking about cracks under the surface for the last year or so. If any one of those cracks turns into a break, it doesn't matter who you are or how good of a job you're doing. When the market starts building that acceleration to the downside, it's like a freight train. Like you don't stop it. And especially given that Yellen just told us we got to take extraordinary measures because we're right at the debt ceiling again. So there's a number of things. I think we're definitely due for some volatility. I think that we could easily see a 10% pullback, maybe in the 15 range. And if something breaks, we could unfortunately see like that 25, 30, 35, just because of the leverage in the system. It can go real fast when something like that starts to speed up, because you just can't get out fast enough in that scenario.
Yeah. So we could see a snap, but it's questionable whether the economy has been in a recession all this time. Because remember, a couple of years ago, they decided to redefine the definition of a recession, right?
Yeah, absolutely. And that's something to kind of keep in mind, is that, well, maybe like 2022 was, a big version of that recession, and 2023, 2024 was kind of recovering from that recession. And maybe now we're at a point where, hey, we can be off to the races again. So it is interesting when you change the definitions of things, because perception is reality. And if investors believe that things are going to be good, and if people believe that the economy is going to be good, and they believe that like things are better than they were a year ago, then that optimism will work its way into the consumer markets. It'll work its way into the stock market, and we could see things continue to go. Obviously, my biggest fear in general is just that we have like these extreme elevated valuations on all these stocks, but my cycles guy says that, well, that's just because we've had such an advancement, like a technology revolution, not all that different from the industrial revolution, and stocks are just going to run at higher multiples now because of that. So we'll see. It's always different this time until it isn't. So we're definitely approaching the year like it's going to be a good year, right? We have the way that we're positioned. It's a more aggressive allocation in general, but we do have our triggers in place just in case some different things crack or break, where the goal is to ride the wave and avoid the catastrophe. That's kind of what I always tell the clients. So.
Okay, so he signed close to, I think, 200 executive orders his first day. And what that tells me? Like, the guy's known he was going to win for months here, because this didn't just happen. I mean, there's, for one executive order, there's a tremendous amount of work that goes into it. Even if they had something better than ChatGPT, they couldn't just draft these orders, and yet there they were, ready to go. So in a way, this is the most prepared administration we've ever seen, other than somebody that just wins their second term consecutively, just keeps the show going.
Yeah. And when it comes to like the administration itself, I think it is safe to say it's different this time. Trump learned a lot. He's a very competitive person. He didn't become a successful business owner by not being competitive and not finding ways to win and overcome adversity. And so, I mean, talk about the adversity this guy's been through. He went through an administration where everyone was just trying to impeach him the whole time. And then he had, an election that he did not agree with. We'll just call it that. He had COVID that he had to deal with. And then he had to try to battle his way back through indictments and all these different things to try to even get on the docket again. And then he ends up winning the popular vote and the electoral vote, and with the story that everyone wants to hear. And the one thing that I can say about Trump's last administration is he tried to do everything that he said he was going to. And he still has that character where he's going to try to implement everything that he said he was going to. But this time, he knows the rules. This time, he knows the game. This time, he has a much better understanding of who's an enemy, who's an adversary, and who's in his alliance, right? He has a much better idea of all those types of things. So if you know the game plan ahead of time and you're someone like Tom Brady, you're going to go out there and win that football game. And I think you could make the same argument for someone like Donald Trump. He knows the game. He knows the game plan. He knows how everything works now. And this time he got to pick his team. Last time the coaches were picking his team, and he knows better this time around. So for all those reasons, I think that you're right. Like, he's totally, probably one of the most prepared ever, as well as the administration in general. And so everything that I'm worried about, right, because you got to have a wall of worry to make new market highs anyways, it's hard to think that they haven't already thought of all those things and already have a plan of action for that stuff. So again, like, that's why we are like more aggressive and more risk on for this year. And then we always have our metrics in place just in case, right? But I agree with you. I think that this guy's ready. He's ready for whatever, and he's ready for worst case scenario. Like this, like he knows that there's been an assassination attempt on him. He knows that those things are going to come, and he's coming out fighting anyway. So I think it really speaks to, okay, we finally have like that leader in the United States where you can say like, okay, like, yeah, I can respect this guy. Not everyone will agree with him, but it's hard not to respect him for what he's done and what he's overcome and where he's at now.
Absolutely. All right. So if there's one piece of advice you give investors for the coming year, what is it, Eddy?
Well, I would say there's two pieces of advice. So because we got to think of this from two different perspectives. Number one, okay, stick to your plan, keep buying, keep leaning into your equities and make sure that you have some type of exit in place to protect you if something breaks. And on the same time, get rid of that consumer debt. Like we have a ton of people that are probably listening to us right now, and a ton of people all over the country where they have these like crazy credit cards with like 25, 26, 29% interest. You don't need to worry about investing in the stock market if you can pay off that debt you're paying 29% on. That's a guaranteed tax-free rate of return of 29% on your money. So get rid of that. If you can get rid of that, it's going to make your life a lot less stressful, and it's going to make you be willing to take more risk on the other side with your investments. So take care of both sides. Get rid of the debt, and start building your net worth, and think like an investor. You need to think of yourself as being successful in 10 to 15 years, and you can't do that if assets aren't working for you. Exactly.
Hey, Eddy, just tell us where we find you, how we connect with you on the web.
Yeah, easiest thing to do, tactivewealth.com/Eddy-Gifford, or just go to that good old search engine called Google, type in Eddy Gifford. That's Eddy with a Y, Gifford. And you'll be able to, see my X page and my LinkedIn and all that other stuff. So look forward to talking with you if you have any questions about anything.
Excellent. If you've got a question for Eddy, myself, just shoot me an email, kl@kerrylutz.com. The link to his site is in the show notes to this interview on financialsurvivalnetwork.com. And if you go there, we just ask that you sign up for your free complimentary newsletter, like over 65,000 other FSN members have over the years. Eddy, appreciate you coming on, and we'll talk to you again soon.
Yeah, thank you for having me, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.